This is the third risk customization tutorial covering betas, liquidity and Monte Carlo VAR. If you do not wish to run any of these three procedures, simply uncheck the tick box at the top of each procedure. Let's talk about betas. A security that has a beta of 1.1 means that if the price of the benchmark goes up 1%, the price of the security will, on average, go up 1.1% times the benchmark return. Please read more about betas in our white papers section. You could say that the beta of a security measures that security's sensitivity to the movement of a chosen benchmark. The benchmark is usually an index, for example the FTSE 250. In this screen, you can select the observation period within which you wish to calculate the beta correlation of your shares against your benchmark. Value at risk, or VAR, is a statistical procedure that tells you, based on modelling and random numbers, how much value your portfolio might lose over a certain period in a worst-case scenario. Please read our VAR tutorial, which can be downloaded from the white paper section of the Help or viewed within the Help manual. For Monte Carlo VAR, you need to set the number of iterations you require and the annual drift. The more iterations you select, the bigger the size of your sample, but the longer the processing time required. The drift number is what you estimate the return of your portfolio would be for the year. Then set the annualized volatility of that return. Liquidity measures how quickly you can get out of your position when you need to. It is calculated using historical traded volumes for each share. If you selected Yahoo as your data supplier, you will be able to view these daily trade volumes in the Graphs and Charts tab like this. Please watch the tutorial for detailed help on the charting module. Here, you need to set the period of data that you want to consider in order to arrive at an appropriate average volume number. Assidium will do the rest, offering you a report showing your portfolio exposure divided into time bands. The bands are discrete, not cumulative, and they reflect how much of your total exposure you could trade out of within standardized time periods. You can tweak your market participation assumptions from within the liquidity report itself after you have clicked Go. Please watch the next tutorial in this group for more help with setting up the valuation parameters.